From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, the Fed goes from a hawkish hold back to a hike, with bond traders debating if July truly was the end, while the Bank of Japan goes for shock and awe. We begin with the big issue. What now?
The Fed is at this tenuous point.
The Fed and the ECB.
She's doing exactly very, very close to what Powell's doing.
They didn't want to convey accidentally anything dovish.
The United States actually it has been looking relatively resilient.
Tremendous momentum in the consumer.
Housing is doing spectacularly well.
The surge that we're seeing in the U.S. right now.
In the U.S., the signs are still pretty good.
Europe might actually see that too.
All central banks have the same problem.
The BOJ with a surprise move.
The Bank of Japan are tinkerers.
The Fed and even the ECB, I think they're going to take a back seat.
The Fed wants to stop it, they can.
We spend so much time talking about recession or a soft landing.
For us, it's not the concern around recession.
If I'm Chair Powell, I permanently have my fingers crossed behind my back.
Perhaps we're getting a little bit too comfortable around the inflation trajectory too soon.
The bigger risk is for the Fed is to declare mission accomplished too early.
Joining us now, I'm thrilled to say we have BlackRock's Gargi, Chaudhuri, and Allspring's George Bory joining me on set on a Friday afternoon in July, no less. It's great to have you both with me. And George, since you're the closest to me, I'll start with you. It was interesting watching the market reaction to Jerome Powell on Wednesday because it was very minimal. We got a bigger reaction from the Bank of Japan news, it felt like. Are we entering into a post-Fed world for the time being?
Well, as you point out, it was kind of a big yawn. The market sort of expected the Fed to do exactly what they did. They raised rates. They provided ongoing hawkish commentary. But what they really did is they left open their optionality. They created sort of a broad range of things they could do. They're very attuned to the risks regarding inflation, and they certainly want to maintain the confidence of the market. They pretty much threaded the needle. And then, as you said, the Bank of Japan kind of surprised. They kind of pulled up the last anchor, if you will, that's been sort of holding down, sort of markets and volatility. And you saw a nice little pop in global yields. But the baton is being passed from the Fed, to the rest of the world. And Japan has sort of been the last really to kind of grab that baton and run with it.
Gargi, weigh in here. Do you think that the baton is being passed? What's going to drive this market?
Sure. Hi, Katie. First of all, it's great to be here with you both. So what's going to drive the market? I think outside of the central banks, which were obviously very exciting, or at least in Japan, it was very exciting, I think it was the inflation data. And the Fed told us over and over again, I disagreed just a little bit. I don't think they were measuredly hawkish or dovish. They were extremely pragmatic. They said, data dependent. We're going to keep watching the data, go on a meeting by meeting basis. I'll give him A+ for measured responses. And I think from here on, we continue to watch the trajectory of inflation to see how they might respond in September, in October, or beyond. So for us in the markets, I think paying attention to the trajectory of core services ex-shelter, which we know obviously is very important, and that has been declining. If you look at the 3-month annualized, that has come back beyond that 2% level. Seeing the trajectory of that, I think today the ECI data was quite interesting. Again, that annualizing down to 4%, still not consistent with the 2% inflation, but moving down from where it was previous quarters. So the baton surely this week was handed to Bank of Japan because they surprised a little bit, not actually at the meeting, but the Nikkei article. But I'd say going forward, continue to watch the trajectory of wages and the trajectory of services ex-shelter.
Well, you bring up the data, and obviously the Fed is looking at everything we are. And it was interesting. We heard Powell talk about the Fed staff. Remember, they made that recession call. Now they have an update.
The staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession.
And And George, I mean, I thought that was pretty striking because when the Fed staff came out with that recession forecast, of course, it made a lot of waves. But you look at the data just that we got this week, solid GDP, the employment cost index out today coming in pretty good. Is this what a soft landing looks like?
We're in a soft landing. And many people continue to talk about this eventual soft landing. We're in the midst of a soft landing, as we just discussed. Inflation's coming down. The Fed has dramatically moderated its pace of tightening. They continue to signal that they may be close to the end, but they still want to preserve that kind of confidence of the market. And growth is holding up better than expected. So that all sounds like a pretty soft landing to us. And the question is, does it continue? How long can it last? Does this sort of tightness in financial markets ultimately result in a recession? We think it could, but it's still going to take some time.
Gargi, does your base case look like that?
I would agree with you. So far, all of the data, or much of the data, has been much more stronger than we would have thought. You know, housing is one that I have been surprised by the strength of that data. But I still think for us to call a hard soft landing for the entirety of the cycle, it's still too early. So let's see how the economy evolves from here on. So far, consumption, amazing. Even when we look at the details of second quarter, yes, we slowed down on the consumption front on the second quarter as compared to the 4% we got in the first quarter. But even at a 1.6%, that is a strong consumption number. So I think from here on, what we have to focus on is the impact of these 525 basis points of rates, how that's playing through to the consumer. And I think it's too early to say. I honestly think it's too early to say.
Yeah. You make great points. And we think that the key thing to focus on is balance sheet strength, both from corporation standpoint and individual standpoint. That's created a lot of kind of gas in the tank. So if you're well financed as an operating entity, you have tremendous financial flexibility in this cycle. We think that's where sort of many folks have kind of either missed the mark or haven't focused on it enough to kind of allow the durability of this kind of ongoing recovery to continue. And so when we look at sort of the corporate structure, we look at individual balance sheets, they're still in pretty good shape. And so we would sort of create it, it's like a melting iceberg. It's slow and steady. It is eroding as yields have gone up, curves have inverted, and financial conditions have tightened. But that iceberg's pretty big, it's pretty deep. Eventually, we will find a meaningful crack in that iceberg, but we haven't found it yet. And it could be a while till we actually get there.
Well, to torture that metaphor, I hope that we're not the Titanic. But I do want to talk about the evolution of what monetary policy could look like from the Fed if we are heading into a soft landing, because we did hear from Jerome Powell. He said that, quote, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce quantitative tightening. So first off, I do like to imagine a world where things are okay. And Gargi, I mean, maybe you had a different interpretation, but I heard reduce QT, but not end QT. Could you see a situation where the Fed is cutting rates but continuing to wind down the balance sheet?
I mean, you know, they definitely were. This is the first time I think they opened up this window to a world where they're talking about a lower rate environment. So when he was asked specifically around the question of, you know, are you going to keep hiking rates till inflation gets to your target? I thought that was the most important paragraph in otherwise what I called an FOMC. Right? It was boring and slow. But he talked about this world in which inflation doesn't have to get to target. That's not what they're aiming for. It just has to move down credibly and sustainably. We're going to hear those words over and over again. He's going to tell us what credibly and sustainably means. And I think this world where we can eventually move to an area where we're no longer restrictive, because he said we're restrictive now. So opening the window to a world where we're no longer restrictive and then getting below neutral. I thought that was really important. That was something that he needn't have gone to. He pointed at the dot plot, which they don't like to do usually. He pointed at that and said, look, we're talking about cuts for 2024. So we've definitely been in the higher for longer rates camp, and that actually bodes well for owners of high quality fixed income. We like to talk about bonds being back, Barb, not Barbie. but also I'd say that we are opening up our minds to a world, perhaps in the end of 2024, if inflation does come down credibly and sustainably, that yes, we perhaps could see rates coming down from below these extremely restrictive levels. Not back to zero, but below the restrictive levels.
And I want to go back to the Bank of Japan because, George, you brought it up in your first answer. And honestly, I debated whether or not to lead with the Fed or lead with the Bank of Japan. So let's go back there, because in tweaking yield curve control, I thought it was interesting. We heard from Governor Ueda saying that today's move, not a step towards normalization. That's the message that they're trying to deliver. But George, when you look at this move that they did make, regardless of their intentions, what signal do you take from it?
So they're not defining it as a definitive step, but it's clearly guiding the market to expect that step to come eventually. By sort of expanding the range on 10 years, they've effectively sort of set, the ceiling. That is sort of it's a move towards tightening, and that is a meaningful shift in policy. And again, to use that analogy, it's kind of pulling up the last anchor that's been holding kind of a cap on volatility in fixed income markets. And that's why the market itself more broadly has kind of tried to revalue in anticipation of that move. So we think it's coming, and this is just the first baby step to kind of get them in a position to actually change policy.
And just quickly, does that give you any pause when it comes to going out the yield curve on duration?
A little bit, but not a lot. We would expect this to be very, very incremental. The Japanese need to worry about their own yield curve first and foremost. It does sort of maybe change some of the demand dynamics for currencies outside of yen-denominated assets, so we need to think carefully about dollar-denominated fixed income. But there's still a very strong kind of demand equation that doesn't go away. Perhaps it becomes less strong, but still pretty strong. We still like duration in here, up around 4%. Given the inflation trends we just talked about, adding some duration to your portfolio, to us from a value perspective, makes a lot of sense kind of over, kind of the near to medium term.
And we only have about 45 seconds left, but would love to end with you, Gargi. The thought that Japanese bond buyers might stay home, where does that leave you on the Treasury curve?
We'd say about the 3 to 7 year point. That's the perfect mark. Like, go out a little bit, own some duration, but you don't really need to extend too far out. So looking at the ag, actually, looking at TIPS, looking at TIP, gives you that belly duration, gives you some income, or take advantage of the volatility in the bond markets and, some covered calls, maybe something like a TLTW. All of that, a lot of income in your portfolio.
Guys, this was great. On a Friday afternoon, no less.
Love it.
Gargi, Chaudhuri, and George Bory, thank you both so much. Up next, it's the auction block, Waste Management, doing the dirty work in issuance this week. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe. The primary market logged its 19th no sales day of the year. Market-wide volume stalling at just 1.6 billion euros, marking the quietest summer week since August 2020. In the U.S., high-grade bond sales are approaching $15 billion this week, falling short of estimates despite a well-received offering from Waste Management. And in the junk bond market, slowly coming back to life after a pause on Wednesday. Arconic's LBO pushing high-yield debt sales above the $3 billion mark this week. Meanwhile, BlackRock's Rick Reeder isn't too excited by junk bonds right now.
Part of the argument against high yield this year has been the spread's not interesting at all. You can get yield in a bunch of other places. You're getting a lot of tight stuff, and you're getting a lot of what I would argue companies that are under some stress.
Joining us now, I'm pleased to say, we have Will Smith of AllianceBernstein and Voya's Matt Toms. And Will, I want to start with you in your chair as the director of U.S. High Yield. Seems like Rick Reeder isn't seeing anything too exciting right now. What interests you when you look at the totality of the high yield market?
Hi, Katie. Nice to be here. So broadly speaking, I think Rick's pointing out that there's a lot of high yield that's already pricing in a pretty optimistic outcome. So those are names that you would anticipate have some sort of an investment grade potential over the near term. And we think that is reasonable, and there's not a ton of value there. And then when you go out the curve and you're looking at somewhat stressed credits, that's where you really need to do your digging. We don't think overall that space is not a good place to be. We do think there is some significant pockets of value, bonds that are trading at significant discounts to par and very wide yields. So we think it's a really good environment to be a credit picker.
A credit picker, you've got to be selective here. I'm hearing that in the equity market as well. But Matt, weigh in here. When you're thinking about the corporate credit market, where are you on the risk spectrum?
So all else equal, you don't want to be at your max risk position right now. Up in quality, as Rick references, there's still yield to be had in the world. So you don't need to stretch quite as much. The pickup from triple Bs to go to double Bs into the high yield space is about 100. That's uninspiring historically. It's not terribly rich, but the skew of economic outcomes to us looks like you probably have a malaise or a potential crack and leap lower. So with that skew of risks, you want to be biased up in quality. When you do go into the high yield markets, looking into things like single A CLOs, which are dislocated and offer a meaningful spread premium in the 400 to 500 basis point range as you move into CLOs and CMBS areas, which is the loans or commercial real estate, offer much more value to take the same economic risk. We'd focus there a bit more than in the corporate bond market.
Okay, point taken. I want to take you both, though, to the world of exchange-traded funds, which is where I live. There was a really interesting story out from some of my colleagues that if you look at some of the biggest junk bond ETFs right now, we're talking HYG and JNK, that the notional value of short interest is approaching $7 billion, which is very high. And Matt, I'm hearing you say up in quality. When you take a look at high yield, do you think it's worth shorting there? Is there ever a world in which you would consider shorting some of these riskier names?
I think absolutely. It's not a huge yield give compared to what you can do in the higher quality components of the market. And look, liquidity is actually improved. The Federal Reserve and the global central banks are removing liquidity globally at a broad level, but within the markets themselves, liquidity is actually pretty solid, and that increases the desire to play both sides of a trade. And so it's not a core position. We're not short risk actively right now. We're just moving up in quality, but it's a rational strategy to consider.
All right, playing both sides, potentially. Not right now, but maybe in the future. Will, I am curious, though, when you do look at the broad high-yield indexes, and to your point, of course, you have to be selective here, but you look at the high-yield spreads right now, currently well below 400 basis points, 370 basis points, in such a tight range. If you crunch the numbers, this range is the narrowest it's been really in over a year. What would take a breakout? What do we need to see meaningful movement in some of these spreads measures?
Well, I think a few things could happen, Katie. I mean, we could see that inflation continues to move lower without really any cracks in the growth side. So that could mean that spreads continue to tighten. So, I mean, it wasn't too long ago, less than 18 months ago, where spreads were at 290. So I think it's worth noting that there is room for spread compression. But we are more in the camp that there's several more ways that spreads could widen. Spreads could certainly widen because inflation is sticky. They could widen because growth is actually a little bit weaker than we anticipate. So, the way we look at it, we think the risk is kind of skewed to the downside. So we're playing overall high yield more conservatively than we normally do.
You bring up spread compression, and that's something I've been wondering if, when you think about the investment case for high yield right now and credit in general, is it the bet that you're going to see further compression here, or are we really in coupon clipping mode?
Yeah, we're in a carry clipping mode, Katie. And for the folks that look at high yield as a decent short, I mean, the big question to me is what is the long against that? Because if it's equities, we'd argue that that's going to be a more challenging hill to climb because we anticipate that growth is going to continue to slow, and some of the multiples look pretty full on the equity side. So when you look at high yield in a absolute sense, it doesn't look like there's a ton of value when you're looking at spreads, but relative to other asset classes, we think there's room to earn pretty significant all-in yields. High yield is basically at about an 8.5% yield, and that looks pretty good versus a lot of other asset classes.
Matt, I'd love to go cross-asset here, and we actually had an interesting conversation on Bloomberg Television with Andrew Balls of PIMCO earlier this week. Let's take a listen.
Given the tightness of credit, I think it makes sense to be a little bit underweight here. And there's other alternatives. There's other ways of earning spread without that exposure to corporate credit.
Matt, I think it's an interesting question. I mean, when you're talking about spreads this narrow, such a narrow pickup, especially when you think about some of those high grade names, why bother with corporate credit at all? Why not just be in the treasury market?
So there's yield to be had in the treasury market, but as Will references, it's also, would you short the income? Shorting income is a dangerous way to make a living in fixed income. So I think the statement is, we would agree in the higher quality segments, treasuries are fine. 4% 10-year will get you home. And importantly, if the world does break towards a downside event, can rally to offset some spread risk. But because you have that potential for interest rates to rally, you can afford some credit risk in your portfolio because you have an inherent risk hedge in duration should things move south. So we agree. Our play would be to look to short volatility. Agency mortgages have performed incredibly well. They're short vol. As interest rate volatility declines and as correlations with equities move from positive to near zero or negative, you're still paid to take some spread risk. It's just a matter of how deep down the credit spectrum you go. And we don't think you have to avoid all credit risk. It's just how far down the spectrum you go.
Guys, gotta leave it there. Really enjoyed this conversation. Will Smith and Matt Toms, thank you both so much. Have a great weekend. Still ahead on this program, though, it's the final spread. The week ahead, Jobs Day in America. That's up next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, we'll get Euro area GDP on Monday. Then earnings pick up again on Tuesday with AMD, Starbucks, and more. Wednesday, we get tech earnings. Another round of jobless claims coming on Thursday, plus the BOE. And then Friday, it's the main event, Jobs Day in America. Let's quickly look at what the estimates are. The headline figure expected below 200K. Unemployment rate holds steady. Wage growth continues to cool. We'll see where we end up, but that does it for us for now. This is Bloomberg Real Yield, and this is Bloomberg.